Let me record that. Sorry. Yeah. So what I've said, we are doing a revision on what we call the company reconstruction. The company reconstruction. So we have seen there are two ways in which the reconstruction can be done. There is the internal reconstruction, and there is what we call the external reconstruction. Internal reconstruction is where you will reorganize the capital structure without liquidating the company. Then we have the external reconstruction where now this will involve liquidating the company, and the company may be taken by a new or existing company. Simply is a takeover. The takeover may be in form of a new company or existing company. Now I see here the recently tested area was on the external reconstruction. Internal reconstruction, the last time they tested was on August 2024, April 2024. That is when they were able to test on that. But however, we will be able to revise on the board. So I will begin with what we call the internal reconstruction, but we'll still be able to do on external what? We will still be able to do on the external reconstruction. So on the internal reconstruction, on the internal reconstruction, on the internal reconstruction, on the internal reconstruction, we will do on internal reconstruction, we will do in the sitting of November. On the internal reconstruction, I will do in the sitting of November 2015. I'll do question number, not November 2015, that one I seen with it. Yeah, we can do in November 2016, question number 3B. November 2016. November 2016. We do question 3B. November 2016. We can do question 3B. November 2016. We do question 3B. It's just the same question if you relate with the one in November 2020. So I can just do that. November 2016, question 3B. Following is a summarized statement of financial position of P Limited as of that year, June 2016. Given the shillings in millions there, we have the non-current assets we've been given for the tangible, and we also, the tangible, we have the pre-owned property, and then we have for the plant. Intangible, we've been given the patents, and we also have the goodwill. Current assets, we have the inventory, we have account receivable, we've been given the investments, where we have the market value, which is 224 million. Current liabilities, we've been given the account payable. Bank overdraft, we have the debenture interest payable accruals, and we have the director's loans. Finance by, we have the share capital, 120 million ordinary shares of shillings 10 each. We have 6%, 64 cumulative free franchise shares of shillings 10 each. We've been given the revenue reserve where we have the accumulated losses. Non-current liabilities, we have the 6% debenture. The court approved a scheme of reorganization submitted by the debenture holders and agreed upon by other interested parties to take effect on 1st of July 2016. Details of the approved scheme are as follows. Number one, the 6% debenture holders were to take their interest paid in cash and to take over part of the freehold property. We've been given the book value of the was 160 million. They were to take it at a valuation of 192 million. In part of repayment of their holding, the 6% debenture holders are also to provide additional cash of 208 million secured by a floating charge on the company's assets at an interest rate of 12% per annum. Given that the patents and goodwill are to be written off, shillings 120 million is to be written off. Inventory will be written off inventory, and 93.6 million is to be provided for bad debts. Being given the remaining freehold property is to be revalued at 620 million. Investment was not at the prevailing market value. Directors were to observe the settlement of their loans as 90% thereof by allotment of ordinary shares at bar value and as to 5% in cash. Balance of 5% was to be waived. The trade payables are to be paid shilling 0.1 in every shillings to maintain and obtain an extension of the credit period. Bank was sanctioned an overdraft limit of 10 million to provide working capital. The 6% preference dividends are 4 years in arrears, of which 3 quarters are to be waived. The ordinary shares are to be allocated at par for their balance. Given there that 6% preference shares are to be written down to 7.5 shillings each, and the existing ordinary shares to shillings 2 each. All the ordinary shares are to be consolidated into shares of shillings 10. The rate of dividends on preference shares is to be increased to 10%. Given that there are capital commitments amounting to shilling 600 million, which are to be cancelled on payment of 3.1/3 of the contract price as a penalty, you are required the capital reduction to record the scheme of the reorganization. That is what you are required, the capital reduction to record the scheme of reorganization. So we'll begin with Roman number 1. This is a capital reduction account. I will have it as the capital reduction account. Now, the capital reduction account here, the shillings are in been given them in the million. So I will have the shillings in million. Shillings in million. And then I will have the shillings in million. So that is where we'll begin. Now, capital reduction is the capital that is reduced. So now, this is what I want to begin from. When we say assets should be equal to capital minus plus liabilities. I mean, this is from what we call the accounting equation. Assets should be equal to capital plus what? Liability. So anything on assets, always these are on the debit side. Anything on this side, this is on the credit side. So anything that will be increasing the capital, it has to be reducing the asset. For it to be on the credit side. Anything that in this case will be reducing the capital, we will have to debit it. Anything that will be increasing the capital, we will be able to do what? To credit that. So let me just begin from the additional information. Begin with the additional information number one there. Begin with the additional information number one. The 6% debenture holders were to be paid, to have their interest paid in cash and take over part of the freehold property. Now, if you look at the freehold property that they are going to take over, they will take over at 192 with a book value of how much? The investment property is having a book value of 160. So you look at whether there is a fair value gain or what we call the value loss. Now, what is the impact that they are taking over that investment? What will be the impact on the capital? What will be the impact that it will be having on the capital? The asset here, this is they are taking over an asset at 192, which in this case the asset is having how much? 160. Now, the purpose of this asset is to do what? To pay the debts, the debenture holders. So we are using this asset to pay the liability. Are we together? Meaning that it will be on the benefit of that liability, and therefore I will add the gain. This was on, they were paying the debentures. We were told that the 6% debenture, they took over. So gain on transfer of property. This will be that 190 minus 130, 192, 160, sorry. This was 192 minus 160. There was a gain of 32 million. Now, what was the purpose of this? It was to pay the debts. They were paying what we call the debts. Now, the debt that was being settled was having how much? If you look at the debentures there, the debentures were having a value of how much? Because we were told that in this case was to be used. Now, debentures from the trial balance. The 6% debenture was 600. What they have been able to settle here was how much? We've been told that they were to take over, or this was to the 6% were paid interest in cash and take over part of, or this was to pay the interest accrued. So, if you look at the interest, that is a debenture payable, not to pay the whole amount. Yeah, they have not paid the whole amount. There is a balance of 4 million on what we call in the debentures. We'll also be able to check on that. Now, let's just get to the additional information number 1 again there. We were told that the 6% debenture holders are also to provide additional cash of 208 million. 208 million secured by a floating charge on the company's asset at an interest rate of 12% per annum. This will increase our bank balance. Then I can also have a bank balance, a bank account. We do all of them together. So let me have the bank account. Let me have the bank account. Now the shillings are in millions. Shillings here, they are in millions. So what was the balance wrote down on the bank? It was an overdraft of how much? Balance wrote down. It was an overdraft of sorry. It was an overdraft of 300 and what? 312. So now they will receive from additional information number 2, 6% debenture. They will be receiving how much? 208. We continue. We're also told that patents and goodwill were to be written off. When the patents are written off, you will debit you will credit the patents account. You debit what we call the capital reduction. So the patents. So patents here was of how much? From the trial balance, the patents we have is 244. Then we also had the goodwill. We'll also be having the goodwill. All of them were written off. So this will be equals to how much? They wrote off 224. We continue. On the same additional information, we were told 120 million is to be written off inventory. When you write off inventory, we'll be reducing the asset, meaning that on the asset account, you will credit, so you will debit the capital reduction. We apply the rule of debit and credit. So here they will be reduced by how much? 120. Same case to the receivable. We had a bad debt of how much? 93.6. We know. Bad debt reduces our receivable. So we'll debit the capital reduction account. We credit the receivables. This was 93.6. We were also told that the remaining real property is to be revalued to 620. Now, how do we get the remaining real property? This one was revalued to 620. When you look at whatever is on the trial balance, for the real property was 680. So it was 680. There is what they have given out to pay the interest In additional number 1 of 160 minus 160. So we want to know whether it's a revaluation gain or loss. This is a revaluation gain of 100 million. So you'll also have that revaluation gain. This is on remaining property. Remaining property. I will have it here. They will revalue it to 620. You in minus, they were able to write it all from it was 680. What was taken over is 120. So there is a revaluation of 100. Remember on the revaluation of the rule of debit and credit, you will debit the asset account, you credit now the capital reduction account. We continue on additional information number 3. On additional information number 3. On number 2 again, there was the investment was sold on the last part. Investment was sold at the prevailing market value. So when you look at the market value of the investment from the current assets, they were 224. So here there is also a gain on disposal of that investment. Gain on sale of investment, which was of how much? To be the disposal at 224. You minus the book value 88. How much is it giving you? They were disposed at a gain of how much? 224 minus 88 at a gain of 100 and what? 36. We continue on additional information number 3. We were told that the directors were to observe settlement of their loan as at 90% they are owned by allotment of ordinary shares at par value. I can have the ordinary share capital as well. Yeah. Ordinary share capital. Shillings here, they are in millions. Shillings here, they will be in millions. So the balance down the ordinary share capital was of how much? Balance down for the ordinary share capital we were having from the trial balance, it is 1200. There is on additional information number 3, the directors were to accept settlement of their loan. This is from the director's loan. 90% of it will be settled by allotment of what? Allotment of shares. So 90%. Director's loans on current liabilities were 160. How much is they giving you? 0.9 you multiply by 160. They will settle 144, meaning that they will increase our ordinary shares. On that, we were also told that 5% is paid in cash, meaning from our bank account, directors' loans, 5% will be paid of 160. What is our 5% of 160? That is 16, and multiplied by 5, it will be 8. Will be 8. Then we were also told that the 5% was weight. Directors 5%. was waived. So if it is waived, it means it's also capital reduced. The director's loans 5% or 160. They reduced the 80 shilling. It was waived. We continue. On additional information number 4, trade payable are to be paid 0.1 in each shillings to maintain and obtain an extension of the credit worth period. If you pay them, they will reduce our cash. These are payables. So you will take the amount that was paid from the current liabilities, 100, you multiply by 0.1 because it was of 0.1, meaning that here they paid 14 shillings. There was no other information relating on the same, so we can continue. We continue. On additional information number 5, the bank has sanctions an overdraft limit of 10 million to provide working worth capital. So that has no any impact as at that point. Go to additional information number 6. We've been told that the preference shares dividends are 4 years in arrears, for which 3/4 had to be waived. The ordinary shares are to be allocated at fair to the balance. So we'll begin by first determining the total preference shares, which will debit the total preference shares in arrears. So you go to the capital, the statement of financial position there, which we were given. On the preference share, the rate is 6%. You multiply by 6/4 times, it was 4 years in arrears, which in this case it will be how much? 640, 0.06 you multiply by 4. This is 153.6. 3/4 of these was waived. So waived preference dividend. This will be how much? You just take 3/4 over 153.6. So answer 3/4. What was waived was 115.2. Now the other one was settled through the issue of ordinary what? Shares. So I will add it here, which will be for the preference dividend. That is now 1/4. 1/4 over the total 153.6. It'll be how much? 1/4 multiplied by 153.6 will be 38.4. 38.4. That is what was settled through the issue of ordinary shares. We continue. Preference shares are to be written down to 7.5. So when preference shares are written down, you will debit the preference share capital account. You credit the capital reduction. So preference shares. These are now for preference shares. You know, the number of shares we were given, they are 64 million. They will be reduced by how much? This is, we were told that they will be reduced to 7.5. So 10 minus 7.5. That is the capital that will be reduced per share. Currently, from the statement of financial position, the value is 10. They will write it down to 7.5, meaning that per share, they will reduce it by 2.5, 64, 2.5. This will be 100 and what? 160. 160. We continue. Existing ordinary shares are also to be written down to 2 shillings. We also have the ordinary shares. Ordinary shares, the number of shares we know they were 120. They will be written down from this is 10 to 2, down by 8 shillings. So 120 multiplied by 8, this will be 900 and what? Yeah, you debit the ordinary share capital, yep, with the capital reduction. Capital reduction here on ordinary shares. Capital reduction will be 400. We've gotten 960. And then there is also some other thing that I got here. If we dispose this investment at 224, from additional information, number 1, the last line here, we were told that, number 2, sorry, the last line, the investment was sold at the prevailing market value of 224, meaning they were to receive these 24 million, the proceeds on disposal of this investment. They want to receive how much? They want to receive the 224 million. Yeah, I had forgotten that cash that they will receive from there. We continue. All ordinary shares are to be consolidated into shillings 10. So hiyo tutaweka hapo ni consolidation. If you consolidate the ordinary shares, there will not be any impact on the prices or on the value of the share capital. Now, we were given on the additional information number 8. There are capital commitments amounting to 600 million, which are to be cancelled on payment of 3/3 of the contract prices are what? Penalty. We pay that penalty as an expense 3/3% of the 600. That is 3/3 of the 600. So it will be 600 you multiply by 3, 1/3%. I'm getting 20. It will have to be paid. You pay it through cash, the penalty. This 3/3 of 600 will be how much? The 20 million. It will be paid through cash. That is now what will be paid. And we also knew that out of the payment, it was also on additional information. Number 1, I did not put the interest because they were to be paid in cash. The debenture interest there. Debenture interest. Payable from additional information. Number 1, it was payable in cash, which was 36. So they were to pay the debenture interest in cash, as we've been told there. So there is no other information that I've been able to omit. With that, we can now balance. We can now balance. And for this one, do not forget the accumulated off. You always debit the accumulated losses. Accumulated losses, generally what is happening will credit the retained earnings account. Then we debit the capital reduction account. So balance. So what will be our balance in figure? This is 244 plus 224. The accumulated loss was how much? So not included the amount 656. So 224, you will add 120, 93.6, 153. Now 20, 656. This is giving us 1110. Let me add again 44. Add 24. 120, 93.6, 153.6, 20, we'll add 656. This is giving you 1511.2. Now, this one should also the same and 136.8, 115.2, also add 169.60. Yeah, should be 11, 15, 11.1. So the capital reduction should balance. Now we need also to know the balance in the bank. Balance carried out, this is 208, 224. This will be 432. Also be 432. Our balance in figure, which is the balance carried out, minus 312, minus 8, minus 40, minus 20, minus 36. It is 16. You also need to know the balance carried down on the ordinary share capital. Balance carried down. Balance carried down will be 1200. 144 plus 38.4. This is 1382.4. This other one 1382.4. You minus 96. So it will be 422.4. So that is on Roman number 1, the capital reduction. We can do now the statement of financial position. This will be limited statement of financial position. They should be as at when they are doing the reconstruction. When they are doing the reconstruction as at 1st of July 2016. 2016. So you have students here, they will be in video. So I will have the assets. For assets, we will begin with the non-current assets. Non-current assets. So I will begin with the freehold property. Now here we'll only consider the remaining freehold property. It was valued to how much? We were given that it was revalued to 620. We consider it as the revalued amount. We were also having the plant and equipment. The plant, this one we did not touch it. Land was at 980 shillings. Now for the intangible assets, they have been written off. Both the patents and the goodwill. So we will write them off. So we'll not consider that. I will have the current assets. Current assets will have the inventories. Inventory from the trial balance, it was 680. There was the inventory written down of 120. So you will eliminate the 120. This should be 560. And also on the account receivable. Account receivable. Account receivable here was 776. We have to provide for the bad debts. They were 93.6. How much is it giving you? It is 776, 93.6. This should be 682.4. 682.4. We'll have what we call the bank balance. What we've been able to determine here, it was 16. So you can get the total assets. And now the total assets. This will be 620 plus 80, 560, 682.4 plus 16. This will be 1958.4. 1958.4. There is that is for the assets. Now we go to equity and liabilities. The equity and liabilities there, I will have the ordinary share capital. We know the balance. Ordinary share capital is 422.4. We have also the preference share capital. Now, from the trial balance, the preference shares were of how much? They were 640. Capital reduced on preference shares is 150. Giving you how much? 640 minus 160. This is 408. Go to non-current liabilities. Non-current liabilities here, we have 6% debenture. 6% debenture. The 6% debenture. Now, the 6% debenture will be, it was 600. There was the one that was settled through the issue of what we call the transfer of property. So 6% debenture will be that 600 minus the value that they used to transfer the property on number 1, which was at 192. This will be how much? 192. 600 minus 192. This was 408. They issued a new one, the 12% debenture, the one that increased our cash. This one was of 2. This was 12, not 6. This was 208. 208 current liabilities. Current liabilities here. We have the accounts payable. Accounts payable here. We had initially they were 400. What they paid from the bank was 40. So this will be 360. Then of course nothing was paid. I need also to have the balance for the accruals, which is 80. So get the total equity and liabilities. For the debenture interest was paid. So we'll just have the total equity and liabilities. So this will be given by 422.4. Another 408, 408, 208, 360, and then 80. I'm getting 1958.4. And that is how we do in the case of capital internal reconstruction. Internal reconstruction. That is how we do that. On internal reconstruction, as I've said, here we reorganize the capital structure without liquidating the company. So here there is no liquidation. The company will not be liquidated. What the shareholders are doing, they are sacrificing their capital to enable the company to finance the accumulated losses. That is on what we call in the internal reconstruction. Now, what we do now in the case of external reconstruction. In the case of external reconstruction, Now, in external reconstruction, the company will be liquidated. So, meaning that here we will be preparing two sets of books. There is a book to close off, the book of the company that will be experiencing financial problems. And the accounts that we maintain, one is the realization account. There is what we call the ordinary members, shareholders member, the ordinary shareholders members account. We'll also maintain the preference shareholders sundry account, and also we'll maintain what we call the purchasing company account, and also the debenture account if it is there. Generally, the purpose of maintaining those accounts is to know the amount that those stakeholders will be able to realize on that liquidation, because the amounts have to be settled. Their dues have to be settled. So how are they settled in the dues of the members who are of the company experiencing financial problems? And then now the other set will be now the set of the new world, the books of the new company. So we can do in November 2018, question number 2, we can do that one. November 2018. Do question number 2. In the case of external reconstruction, we are now, as I've said, the company that is experiencing financial problems is liquidated, and is liquidated by either being taken over by an existing company or new company. We maintain two sets of accounts, one to close off the books of the company experiencing the financial problems, and then we now open a new account for the company, the new company that has been able to take over the world, that company experiencing financial problems. Now, and read on that question number 2. Here is B Limited and H Limited private liability limited companies operating in the service sector. Even that they have been reporting successive trading losses for several years, principally due to several competition which has put downward pressure on their revenue. Directors of two entities who are also the main shareholders have unanimously agreed to wind up the company's respective businesses and amalgamate them into a new company to be named S Limited with effect from 1st of October 2018. The statement of financial position of the companies is that 30th September 2018 are set out below. We have the B Limited and we also have the H Limited. Assets we've been given the non-current assets where we have the PPE. We also have the intangible assets. Given the current assets and we have the total assets. On equity and liabilities we've been given. Ordinary share capital 7%, 7.5% cumulative preference share capital. We have the share premium and we also have the retained profits. Non-current liabilities, we've been given the 10% bonds. Current liabilities, we have the trade payable, bank overdraft, and we also have the total equity and liabilities. Authorized share capital, the new company was 120 million, comprising of 12 million ordinary shares of shillings 10 value. Now, when we talk of authorized share capital, is the maximum amount of capital that a company can do, can raise. So here they are giving us the number of shares that the company can be able to do, to raise. So in our case, when preparing financial statement, we only consider the issued ordinary share capital. So that information is not of any use in our presentation there. Preference dividend in B Limited were 3 years in arrears, while preference in H Limited were preference dividend had not been paid for 2 years, including the current year to 30th September 2018. Only 20% of the arrears of the preference dividend was settled by issue of ordinary share capital of shillings 10 in S Limited. We've been given there that S Limited issued 3.4 million ordinary shares at shillings 10 each, credited to 5 each of the 4 of the preference share holders in both companies. To ordinary shareholders were allotment on the basis of preference shares held in the old companies. We've been given there that the preference shareholders committed to immediately pay the balance on the shares reissued. Bond orders in the both companies were settled immediately by the new company issuing ordinary shares of shillings 10 each to satisfy the nominal value of the bond. Whether the new company also issued 4.6 million ordinary shares of shillings 10, credited 2.5 shillings each in favor of ordinary shareholders in the old companies. Given that the ordinary shareholders were allotted on the basis of the ordinary shares held in the companies, ordinary shareholders were to pay the balance on the shares immediately. Given that the current liabilities of the old companies were transferred to the new company at their book value. The copyrights in B Limited expired upon amalgamation of the two old companies and therefore were therefore to be written off. Tangible assets were taken over by S Limited at their fair value as follows. We've been given their property, plant and equipment, and we also have the current assets. Now, liquidation expenses of B Limited and H Limited amounting to 8 million and 5 million respectively were paid for S Limited and treated as preliminary expenses. When you talk of preliminary expenses, any expense incurred prior to commencement of a business. Then you are given there that assume all the above transactions were completed by the closure of business on that year, September 2018. You are required the following ledger account in columnar form to close off the books of the B Limited and the H Limited. They want the realization account, preference shareholders sundry members account, and also the ordinary what? Shareholders sundry members account. That is what you are required. Now, when you get such a question, the starting point is to determine the purchase consideration. So we'll begin with purchase consideration. Now, what we mean here is what the X Limited was able to pay to acquire these two companies. So how he was settling, what these are the stakeholders of the old companies, how they were able to settle that amount. So here I love the shillings in millions. Now I will begin with from additional information number two, to the preference shareholders. Preference shareholders. You have a preference dividend. So we have the preference shareholders. Now, to the preference shareholders, we were told that they were 3 years in arrears for B Limited. So this is the preference dividend. I want to see how the preference dividends was settled. This is the preference dividend. We see how they were settled. Now, first I need to know them for B and H Limited. B, they were how many years in arrears? 3 years in arrears. So you go to, they were 7.5. This is that, for this one, they have used shillings in thousands. So I will use them in thousands as they are. So I will multiply by 10,000. They were 3 years in arrears. This one was 7.5% of 24,000. Here they were 24,000. They were 2 years in arrears. So get the preference shares, the preference dividend. Get the preference dividend. So this was 0.075 multiplied by 10,000 times 3. This is 2250. And the one is we've been given there. They were 2250. This other one was 0.075 multiplied by 24,000 multiplied by 2. They were, so that is our preference dividend in arrears. So we want to see how they were able to settle the preference what? The preference dividend. Now this is what you were told. We were told that on additional information number 2 there, the only 20% of the preference dividend was settled by issuing how much? Issuing ordinary shares of shillings 10 in S Limited. So easy, S Limited gave them ordinary what? Ordinary shares. So ni kumaanisha for B Limited atapata 20% of 2250. For H Limited, he'll get 20% of what? That is 600. That is what they were able to settle. They were given the ordinary what? Ordinary shares. 0.2, 2250. This one they are 450, yeah? And this other one will be 0.2 times that is 600. So out of that, what they've been able to settle is that amount. 700 and what? 720, and this is by issuing ordinary shares, meaning the ordinary shares will increase by what? That amount as a result of the dividend. We go to additional information number 2 again. Number 3, they were issued, S Limited issued 3.4 million ordinary shares of shillings 10, credited at shillings 5 in favor of what? Preference shares. Put it up again. This was 3.4 of shillings 10 each to be credited at 5 in favor of the preference shares in both companies. The ordinary shareholders were allotted on the basis of the preference shares. Yeah. So tutakuwa pia na ordinary share still to preference shareholders. Ordinary shares. Now, this is it. We'll begin with B Limited. Now, the proportion of the share capital here will be, from the preference share capital will be 10 over 30 what? The total preference share capital is 10,000 and 24,000. So total will be 34. So here, for B will get the 10,000 over 34. 4,000. I will multiply by, this is 3.4 million. I multiply by 10. Those they were of shillings 10. Then for H, you will get the reminder, the 24,000 of 34,000 multiplied by 3,400 times 10, even though I equal the preference shareholders. So this will be 10,000, 34,000. I will multiply by shillings. 34,000 I multiply by 3,400 times 10. We are about 10,000. Yeah. The other one is 24,000. You divide by 34,000 times 3,400 times 10. You will also be having 24,000. That is what they used to settle the preference shareholders. Oh, yeah, what they paid was only 5 shillings. They did not pay they settled, they credited 5 shillings. These are the reminder, which was 5 shillings for Talipa in cash. So what they settled here, what was settled by S Limited is only 5 shillings. So that means here this will be 5. And this other one will be how much? Will be 12,000. That way. I think I could have done it different for both of the companies. So is it too confused? Let me just do it for here to be H, B Limited, and the H Limited. Let me just have it here. B Limited. What is paid for H Limited? Let's just know it differently. It will be more fair and easier for us. So let me just have it differently for both of the companies here. Like for this one, it will be 5,000. This one can be 12,000. Ordinary shares that they were able to issue. I can now for B 20% of 2250. This was 450. And then for H, 20% of 9600. This was 720. Yeah, we now determine the purchase consideration differently. Now we go to the other one. For additional information number 4, we were told that the board orders in the both companies were settled immediately by the new company. This is by issuing shares, ordinary shares of sharing 10 to certify the nominal account. This is now to the debenture holders. Debenture holders. Now, debenture holders here, what they were given again is ordinary shares. Shares of sharing 10 each to settle the whole amount. So that means they settled the exact amount for the debentures, which was bonds. Yeah, it was 20,000. And for each, they will settle also the other one, which is how much? 15,000. They settled by issuing shares of those amounts. We continue. For additional information, number 5, new company issued 4.6 million ordinary shares of shillings 10, credited at 2.5 in favor of ordinary shareholders. This is now to ordinary shareholders. How did they settle this? To ordinary shareholders, they have settled this by issuing ordinary shares again. So ordinary shares here will be how much? I will allow for B limited. They were settled through what? We were told that the ordinary shares were allotted on the basis of the ordinary share capital. So this is what I will be having. It will be 30,000. I'll divide by the total, which should be 46,000. I'll multiply by the shares. The number of shares here was 4,600. They settled them only 2.5 of it. That should be for B limit. Then we'll also have for the H limit. This will be 16,000 over 46. Multiply by 4,600, I multiply by 2 point what? Multiply by 2.5. This will be 30,000. I'll divide by 46,000, multiply by 4,600, 2.5. What they settled here was 7,500. Whatever is 16. This will be 4,000. We continue. The other one was on the current liability. Was settled on that. So we just have the liquidation expenses, which were paid in cash. For the liquidation expense is also what we'll be having here. So for B limited, they paid 8 million. That will be 8,000. That is for B. For this other one will be how much? Were given 5,000. So this will give us the total now purchase consideration. How they were able to settle the current holders of the company shares, preference shares, debentures, and what, and the ordinary shares. So if you get the total, you just get the purchase consideration, which will be equals to how much? Purchase consideration, which will be equals to how much? 450, 5,000, 20,000, 7,500 plus 8,000. I'm getting 14,950. And that is 720, 12,000, 15,000, 4,000, 5,000. This is 36,720. So now we can now maintain the account. I will begin with the realization. Realization account. The realization account will allow for the debit and the credit balance. Here we will have this is the debit side, and on the debit side, you'll have for the two companies. This is the B limited, and now we have for the A limited. On the credit side, I will also have for the B limited, and also on A limited. I will also require these other accounts. I will also require the ordinary members account, ordinary members account, the preference shares, country account. We will require them to allow ordinary shareholders, members account for all of the companies. So I need to have them for both of the companies. So here, we allow for H limited and also H limited. Shillings there in thousands. Here you allow the shillings in thousands. So some case here, allow for B limited. And you also have for the H limited. Shillings in thousands. And also shillings in what? Shillings in thousands. I will also need to have the preference shares. Country members account, the ordinary share, then we have the preference shares. This should be country members account. Members account. You also need to have the account as well. This one, you also have for this will be A. B H limited. They'll also be having for B what? Limited. Shillings in thousands. I will need the shillings in thousands. Same case. Now that B limited and the H limited. Shillings in thousands. I will need to have the shillings in thousands. Now, for this one, all the assets will debit, and you will credit the liabilities. So I will begin with the assets from the trial balance. We have the PPE. The net book value, this is 16,500. That one is 12,000. You will, you have to, sorry. Yeah, you have to debit the assets, you will be crediting the liabilities at their current value. Now we have the intangible assets. What was the intangible asset? The intangible assets were copyright. However, on additional information that was on number 6, number 7, they had already expired as they were doing the amalgamation. So you'll have to eliminate them. So yeah, I will not consider that. I will only consider the current assets. What was the current assets? The value. Here we have 52,500. This other one we have in 30,000. We'll also have on ordinary share capital, that is their balances is at the beginning. So you'll have the balance draw down. Balance draw down here was 30,000. This other one is 16,000. Preference shares also the balance is at the beginning. Balance draw down. Here we were having the 1600, this 18,000. And this other one was 24,000. Now we also have the share premium. That is the increase in what we call the ordinary share capital account, or you can consider them as a part of, and just have it as an ordinary share capital account on its own from that case. But let me just consider them as they are. I will just consider them as an ordinary share, not they will still be the share capital on the purchase consideration. Now, what follows here? On the liabilities, we will have there was a retained earnings, which are the accumulated losses. They will reduce our what? We consider them as part of the ordinary share capital. So they will reduce our ordinary share capital. This was 23,400. And this other one was how much? 34,300. Then we continue. We also have the liabilities here, the trade payable. Trade payables were how much? It was 37,200, which in this case we also have 18,400. Bank overdraft. Bank overdraft here. You will have the 2,000. And we will also have the 1,500. You'll have the liquidation expenses, yeah? Liquidation expense. Liquidation expense for this one was 8,000. The other one is 5,000. There was a different dividend in arrears. Also have them here. The total preference dividend in arrears here, they were 22.50. This other one was 3,600. 3,600. Then also from there we will be having. Now you will also now settle the preference shares here. Now preference shares, first they will be increased by the dividends in arrears. I will have them here. They were in arrears, which was 400 and no, the total 22.50. This other one 3,600. How are they settled now? They settled this by issuing ordinary shares. When you will pay ordinary shares and ngapi? I have the first of 450. Now mwingine akapewa 720. They also settled by also giving other ordinary shares. Zangapi. This is on the purchase consideration. They settled by giving 5,000. And this other one was 12,000. So if you balance here, we'll know what to take to the realization account. So what do we take to the realization account? The realization. This is the balancing figure. So the balancing figure here will be 1250. Here it will be 12,250. What has not been settled generally? That is what we are asking ourselves. What has not been settled here will be 12,250. I minus 5450. It is 6,800. This is 27,600. 27,600. So the realization here will be 27,600. Our minus, this is 12,720. This is 14,880. So to the realization, we have debited the preference share capital account. We will credit the realization. Preference shares. What has not been settled? Here it will be 6,800. This other one is 14,880. Also for the ordinary shares. Now in ordinary shares, we have what was settled. Yeah, through the purchase consideration. I'll just call it the purchase consideration. They settled by paying how much? Preference shares. They settled 7,500 and forward or down. There was nothing else on the part of ordinary share. Only thing that was there is the patent, the copyright that were written on. Those are intangible assets. So any intangible assets, we will eliminate it from here. This was of 8,400 from what we call in the what? Yeah, from what we call in the ordinary shareholders account. So here we can also eliminate them. We know what was taken to the purchase consideration, the balancing figure. So the purchase consideration will be, this total is more. So the realization account, balancing figure. Balancing figure will be 7,500 plus 8,400 plus 23,400. This is 39,300. 39,300. So that will be 9,300. These are the one 34,300. You will add 4,000. This is 38,300. 38,300 minus 16,000 should be 22,300. So we've credited now. How debit realization account? Ordinary shares. This is of 9,300. These are the one of 22,300. So credit the purchase consideration, the total purchase consideration here, which here it was 49,50. And this was 36,700 and what? 36,700. 720, 36, 720. There was nothing else there, so we can balance. Balance here. So 15,500, 52,500, 8,000, 2250 plus 93 and is 88,550. 37, 200, 20,000, 6,800, 4950. This is 104, 950. Should be balancing. I don't know what I've got a little bit. It should be all right. I just know where the difference would be. Consider the frequency of dividend in arrears. We were able to consider the whole amount and what was settled. That is on the preference share, so that is okay. Now we continue. We just continue. There is no problem with that. So this will be 12,000 plus 30,000, 5,000, 3,600, 22, 300. This is 72, 900, 18,400 plus 1,500, 14,880, 36,720. This is 71. The realization account should be balancing. The realization account should be balancing. The ordinary shares the 23, 34, 30,000. Or should be, I should have considered the share premium here. Yeah. The only difference I've not considered is the share premium. Share premium here was 1,600. This other one is 14. And that is what I've not considered there. So we can balance now. So this was 39,300. You add, you minus 1,600, you minus 30,000. Yeah, should be 7,700, yeah. 34,300. We'll add 4,000, that is okay. Minus 16,000. I minus 14,000. This should be 29,000. Yeah, that should be that. So that is 77. They should be 7,700. They should be 29. For the rest, everything should be that way. So now we can balance. Now we just balance. $16,500 down, 52,500, 8,000, 2250, 7,700. And this is 86,950. There's another one that is 7,200, 2,000. That is 849.50. Yeah, it is the same. 86, 9. Yeah. 12,000, 30,000, 5,000, 3,600, 2,900. This is 71,500, 71,500. That is how you are required to prepare those accounts. That is how we were required to prepare the account. Now, Roman number 2, they wanted the journal entries to record. This is the books of the asset to be transferred to the what? The new company. Now this is on opening the new company. So here you have the journal and very fast. The journal entries. Record the books of the new company, which is now the company that we are doing what? We are purchasing here. The company we are purchasing. So I will have the debit side. I will have the credit side. Shillings in thousands. Shillings in thousands. So we will begin with the assets taken over. With assets taken over, we'll debit the asset account. We credit the business purchase. On additional information number 4, I love the PPE. The assets taken over here was 12,500. You just add 12,500 plus the 9,500. How much is it giving you? They will also have there was the current assets. Do the same on number 8. Whatever was taken over, assets. Current assets here is 58,000. You learn that what? 38,600. So that gives us how much? So the total of 500. You add 9,500. This is 22,000. That one is 58,000 plus 38,600. 96,600. You will credit the business purchase. Now with the total purchase account, which should be plus 22,000, to be 118,600. That is on that one. We'll also go to liabilities taken over. Liabilities taken over. You will debit the business purchase account, then you credit the liabilities. Purchase, credit the liabilities. Now, liabilities, we were told that they were taken over their book value. I will have the trade payables. Trade payables is having 37,200 plus 18,400. Plus 18,400. So that is 7,200 plus 18,400. This will be 55,600. 55,600. We are also the back. Sorry, we are crediting. Sorry, yeah. 5,600. You also have the bank overdraft. Bank overdraft here we were given 2,000 and 1,500. This is 3,500. If I get the total, What do we debit on the business purchase account? 5,600, 3,500. It is 59,100. Also look for the goodwill on acquisition. The goodwill on acquisition. Goodwill on acquisition. So with the goodwill on acquisition, we debit the goodwill account. Goodwill. Now, how do we get the goodwill? Will be the purchase consideration. You minus the assets acquired. This is our purchase consideration. The net assets acquired. So it will be 4950. That is 6720. It will be the 77,670. You minus the net assets is simply the total assets here 118,600. You minus 59,100. That way. And here on there was a liquidation expense. You'll also need to add the liquidation expense as part of the assets. So you'll add the 13,000. I've added this. Remember, the goodwill should be the purchase consideration minus the net assets acquired. So you'll have to have the liquidation expense, then you less the liabilities, 59,100. That is what will give us the goodwill. 118,600 plus 13,000. You minus 59,100. So it will be 77,670 minus answer. This will be 51,70. You will credit the business purchase account with also 51,70. You'll also have what we call the purchase consideration. With purchase consideration, we debit the business purchase account, which is 77,670. Then you credit the vendors or the purchasing company vendors account or the purchasing company account. So that is how that will be. And then I can now prepare the statement of financial position. Statement of financial position. This will be now for the new company, Roman number 3, Gas Limited. Statement of financial position this should be as at when. Financial position as at. It should be as at 1st of October 2018, when they are doing the liquidation, shillings in thousands. So we begin with the assets. Non-current assets, we'll just include them at their takeover takeover value. I will have the PPE. PPE was the total 500. I have 95,100, which will go to 22. Will be 22,000. We will have the liquidation expenses, which are the preliminary expenses. Now, remember, preliminary expenses are those expenses incurred prior to commencement of a business, and they are required to be capitalized as per the IAS 38. The 8,000 plus 5,000 This was 13,000. I will also have the goodwill. Goodwill is the one that we've been able to determine there, 5170. We go to the current assets. Now the current assets. Now the current assets here, we will be having the 58. This will be given by 58. 58 volts. Was 58,000. I will add 36,800. Now here I will also require to determine the balance in the cash account. So we'll have to determine that so that we know the current assets, the total assets. Total assets. We'll also have the equity and liabilities. Equity and liabilities there. Equity and liabilities. Now on equity and liabilities, we will have the ordinary shares. Now for the ordinary shares, you will be having all the shares that they were able to issue. Like for example, the different shares, there was the 450. I will add the 720. I will add from additional information number, that was on additional information number 3, the 3.4 million shares that they were issued. I will have the 34 million. I multiply by 10. Same case, the amount that they were able to issue to settle the debentures, they were how much? The 20,000, yeah, plus the 15,000. The amount that they were able to settle the ordinary shares, it will be that 4.6 million. You multiply by 10. By 10 shillings. Just a minute. You know? So this is what will give us the total ordinary share capital. This is what will give us the total ordinary share capital. All the shares that they were able to issue to settle the balances. Remember, it is inclusive of the cash that these others were able to do. Pay. So this will be 450 plus 720 plus 34,000 plus 95 plus 46,000. So it will be 116, 116, 170. That is what will be the ordinary share capital, 116, 170. Now we don't have the preference shares. That one was they settled the whole amount, and there was no new preference shares on the new company. So what we just have is on the current liability. Current liabilities, I will only have the account notes. accounts payable. What was the accounts payable? Will be 37. 200. You add 18. 400. So it will be equals to how much? 37 200 plus 18 400, which is 55 600. Now, I will maintain a bank account. Know what will be the balance. So this one we can get the total equity and the liabilities. Total equity and liabilities will be 116 170 plus 55 600. This will be 171 770. Now, how maintain a bank account? Know what was the balance carried down for the bank. So we had an overdraft, which is our balance brought down. Overdraft was 2,000 plus the 1,500, which in this case it will be 3,500. Now we will have the ordinary shares that they were able to issue. They paid for the sales, the balance in there of 5. So here it will be how much? The balance, remember they were totaling to 10,000. For B Limited, he was paying the 5,000, yeah, the balance. And then here they were for H Limited. H, they were paying the 12,000. That is in settling the preference shares. And also here, the 7.5 that was remaining. So this was how much? Generally, what I've done here is a 10 over 34. Multiply by 3,400, the balance of shillings 5. 10 over 34. Multiply by now 34, this was 24. 24 over 34. You multiply by 3,400 times now the other 5 shillings is what was giving us that. Now we had on this settling of ordinary shares, the only amount was paid was the 2.5, and 7.5 was also not paid on the ordinary shares. Here. So this will be having for B was 30 over 46, 4,600. The 7.5 is what they paid themselves on cash, and the 8 is the same 16 over 46, 4,600 multiplied by 7.5. How much? Be 30 over 46 multiplied by 46 and 7.5. This was 22,500. That one will be 16 over 46 multiplied by 4,600 times 7.5. They will pay these other 12,000 for themselves. Then they will also pay for the liquidation what? Liquidation expense. This one we know it is of 13,000. So our balancing figure is what they will be having as balance carried down in the bank. So it will be 5,000, 12,000. I will also add 22,500, 12,000. This will be 51,500. That is 51,500. 51,500. So the balancing figure is 13,000 minus 3,500, which is 35,000. So this is what we'll add here on current assets. So it will be giving you how much? 96,600 plus the 35,000. This is 131,600. If I add 22,000, 13,000, 5170. I'm getting 171. 700 and what? 70. That is how you are required to do that. This was in case of two companies, and there is the only question they have tested on liquidation of two companies. That is how we do in the case of liquidation of two companies to become one company. You have to do them separately, as we've been able to do. What I've determined here is the balance is that these are to pay to S Limited for them to be issued with the new what? Then the shares that they've been entitled of the full amount. Because what is the S Limited settled for them was these 2.5 shillings. That is how you are required to do on that one. So we'll continue from there in the next class. We do now the earnings per share. We'll continue from there.